And welcome to ETF Edge, your go-to place for everything ETFs. I'm your host, Bob Pisani. Today we'll be talking about the IPO explosion, momentum and quality at new highs, and what to do about yields. That's a major problem. Our guests, three of the best in the business here: Kathleen Smith from Renaissance Capital, Christian Magoon from Amplify, and John Dobby from Astoria Portfolio Advisors. Welcome, everybody, old friends, all of you. John, let me start with you. You've spoken often of your love for quality. You can actually buy this ETF, QUAL, right now. It's at a new high today. These are companies that have stable earnings growth, generally low debt to equity ratios overall. Why does the market like these type of stocks right now?
I believe that quality over time is one of these factors that's persistent, pervasive, robust. We've talked about this ETF quite a bit on your show, ETF Edge, and I think that it's names that everyone knows and can understand. But what we're doing lately, Bob, is we are shifting our portfolios. We are trimming quality. We still like it, but I think that where we are in the economic cycle, the Fed anchoring interest rates at 0%, the Fed doing quantitative easing, I think equities and stocks, broadly speaking, have a green light. So we are shifting our portfolio, owning more cyclically oriented stocks and sectors. Small caps, mid caps, they tend to grow a little bit faster than the overall market, and sectors like energy, industrials, materials. So that's a new twist from us at Astoria Advisors, and I think that that's what investors should be doing as well.
I think the key point here is, and Bruce, I don't know if you want to comment at all, but on this group here, Apple and Facebook shows up on quality. And again, you're looking at companies, low debt to equity ratio, generally good earnings growth, but you also have some very strong consumer names, not associated with big growth necessarily, but stable, Coca-Cola and Johnson & Johnson, for example. So it seems like the right kind of mix. You don't want to throw all your money into tech mega cap. It seems a little bit too much momentum oriented, but quality kind of strikes the right kind of tone for this market, doesn't it?
Yes, I do think so. But what I would point out, Bob, is that since March 24th, QUAL has underperformed the S&P 500 ETF by about 200 basis points. So, there is a change in market leadership, and that I think is important. But yes, I agree with you. You want to have, broad, diversified basket. You just don't want to own, large cap kind of tech stocks. So, that's the message from us, is to kind of tilt away, own more cyclically oriented portfolios. Yes, qual is reaching all-time highs, but so is the S&P 500. But since March 24th, the cyclically oriented sectors, small caps, they've really outperformed dramatically compared to the S&P 500. And that, as you look forward the next 12 to 18 months, I think that's what you want to be doing to your portfolio as we continue to rebound from an economic perspective.
Yeah. Sorry, Christian, I meant to toss to you there. I don't know if you have any thoughts on this. I know you watch the market as well. And I can't help but think, just to repeat the question, I can't help but think that quality is a good way to look at the market right now, even over momentum, because here you're getting stocks that have generally improving earnings, but also low debt to equity ratios, what people would consider some kind of modest value tilt as well.
That's right, Bob. I think, after the COVID crisis, people really want resilience in the companies they own, and Qual really provides that when, it looks at companies that have stable earnings, high return on equity, low debt to equity, all characteristics to kind of batten down the hatches, if you will, against the kind of this unusual economy, and this resilience in these companies in the form of these characteristics, we think not only make a good, investment here in the times of COVID, but should last for quite a long time. And, the performance of Qual has been pretty nice, since not only year to date, but, going back several years. So an interesting ETF. 32% in IT, Facebook, and Google, though, so it might be getting a little ahead of itself in terms of some of its technology and communication exposure.
Yeah. I want to move on to the IPO market because it's been fascinating to watch this year. Kathleen, this is your bailiwick. You run the Renaissance Capital IPO, one of the most successful ETFs of the year. You're up 45%. You're approaching $100 million in market cap. That's nice to see. So not only are prices going up, but you're getting money going into the fund. Flows are positive. 45% versus 5% for the S&P is pretty good. Tell me why you buy a basket of about 60 IPOs that have gone public in roughly the last 2 years. Why have the most recent IPOs done so much better than the rest of the market? What's the outperformance due to? What are investors looking at?
Sure. The IPO market and companies that go public tend to be new economy companies, and they're doing disruptive things. So we're kind of in the sweet spot of what the market's been looking for now. We've had many digital work from home kinds of companies, like Zoom Video is the top holding in the ETF. And I'm on Zoom now. It is just been a very strong stock. Another company such as Slack does enterprise messaging. So these businesses are benefiting from this kind of environment where businesses are moving to a more automated and virtual way of working. Also, we've seen a lot of digital platforms, Rocket Mortgage, for example, they're self-service. So they're able to do customer acquisition at low prices because they're using technology. Lemonade, Renters Insurance, self-service. And then finally, it is a low leverage kinds of companies, as we've been talking about. IPOs tend to be growth companies, and growth companies are really much more valuable in a low interest rate environment, basically because the present value of future growth is higher when your discount rate is so low. So we're in the sweet spot right now of what investors seem to be interested in.
And the future looks pretty bright. Now, we've got some rather notable names talking about going public that have filed confidentially. We have DoorDash, we have Airbnb, we have Palantir. I think it's interesting, Kathleen, like 7 or 8 months ago, there was a lot of talk about direct listings, that maybe DoorDash would do a direct listing, maybe Airbnb would do a direct listing. Oh, we don't need to raise money. That seems to have gone away, the talk about direct listing. Now they're talking about classic IPOs. But give us a quick preview about the rest of the year. What do you see happening?
Sure. I think to see what the rest of the year is to take one look at what's happened so far this year after the market basically shut down in March. And right now, year to date, we're ahead of last year after that shutdown. And in fact, the summer months, including this August, is going to finish up with more capital raised, I think, than any August on the record books. So we're seeing an amazing turnaround, an amazing amount of issuance in the regular IPO market. We're also seeing SPACs come out, which are sort of enabling companies that don't have easy to study metrics get to be acquired through SPACs. So some of the froth, I think, is coming out through the SPAC market. So now we have.
That's a very good. That's a great point. I want to follow up on that point you're bringing up about SPACs. And John and Christian, feel free to jump in. But let me just follow up on that question, Kathleen. You know things are getting hot when we have a SPAC ETF announced. Defiance announced they've got a SPAC ETF that's coming out, which is obviously is going to consist of recent SPACs, special purpose acquisition companies. And I'm wondering if you could comment on that, because that's taken me a little bit by surprise. It started gaining some steam last year, but now it's really big. What's going on with everyone trying to do a SPAC right now? Is it a way to end run the IPO market? Kathleen, just give us 30 seconds on what the SPAC business explosion is all about. What's really the story there?
Sure. The most important thing to know is our products include operating companies, and SPACs are not operating companies till about 2 years after they then make an acquisition. But they're public blind pools. And the way we see it, we've studied these once they make their acquisitions, and the returns are much worse than the returns in the regular IPO market. So investors have to be pretty cautious about when they hold them and whether they'll stay in through the acquisitions that are made at the end. But they're very popular because there are a lot of companies that cannot go public and simply they don't have the kind of metrics that IPO investors want. And so they're able to go public by being bought by a SPAC. And so some of the froth, I think, that could have been in the IPO market, I think the IPO market still has a certain amount of discipline. If any, right now you can say the market does have discipline. And then some of the more speculative vehicles, such as Virgin Galactica, companies that don't make money but are like these big ideas, are getting funded through the SPAC market.
So is it fair to say that in a hot market, and we have a hot IPO market, SPACs are kind of a way to end run some of the public scrutiny that might be brought down on them that are not completely ready to IPO? Is that fair, or am I being
I think that
melodramatic?
explains it very well. And I think it's really buyer beware with this vehicle. But they have to work, and our studies show they don't yet work. So perhaps that will change. But we have studied the ones that have made acquisitions, and the returns have been poor on average, with the exception of some very hot names that tend to then attract investors to the space.
Yeah, Kristen and John, any thoughts on the IPO market? I mean, you have to admit, I mean, the IPO ETF, which is a basket of about 60 stocks, up almost 50% this year. That is really rather spectacular. Perhaps they're lucky enough to be in biotech that's doing well. And of course, as Kathleen says, a lot of it ending up as work from home. But it's still a pretty spectacular outperformance overall.
I would just say that I think the IPO market this year has really captured this theme of the digitization of commerce. And when you look at many of these top performers, Lemonade, Rocket, Zoom Video, Cloudflare, that's the digitization kind of movement, especially in this COVID economy. And then in addition, as you said, there's been some nice, biotech healthcare that has been, unique to the COVID environment. So kudos to this IPO ETF. It's really delivered on its promise this year.
And then I would just say, Bob,
agree with that. Go ahead. Go ahead, John.
Sorry, Bob. I was just going to, I'm a big believer as a quant investor that if you're going to take on the risk of owning an asset, you should be compensated for that risk. So if you look at the IPO ETF from Kathleen's firm, it has produced better risk-adjusted returns than, let's say, the Russell 2000 index. So, I mean, Kathleen may have a difference of opinion about what's the right benchmark, but the volatility of the IPO market, if I match that versus the small cap index, the IWM ETF, I mean, it has outperformed that index on a risk-adjusted basis. So I do think that there's a place for, thematic secular growth stocks, IPO stocks in a portfolio. And what Kathleen said is spot on. Like, in a low interest rate environment, companies that have higher growth prospects, will produce more cash flows as the Fed anchors interest rates at 0%.
A couple of reasons for the benefit of this kind of portfolio is that we put these constituents are the largest, most liquid ones. So when you worry about a low float, we have very high tradable float, which minimizes that those first day pops and things like that. The valuations become sensible, better in the larger companies that go public. Right. And also, these are companies that are not yet in big indices. They're either not in them or they're underrepresented. When Facebook went public, for example, it took 2 years for Facebook to be in the S&P product. So it's a way to own. There's some diversification that comes out of this portfolio.
And Kathleen, maybe this is a good time just to clarify what's in this, because I get this question all the time. And my shorthand answer is it's roughly 60 companies that have gone public in the last 2 years. But can you clarify that? Do you cap the number? And do you set a cutoff date after 2 years you drop them? Just clarify what's in it and point out also there's an international IPO ETF as well, I would say. Sure.
The way it works is it has to be, it can't be more than 2 years from its IPO. So any company there qualifies. But also, if you take the market caps of all the companies that have gone public over that period, the top 80% get in. So we are trying to capture the essence of the IPO market without having the turnover and the stocks that are small and not part of that market cap. And then it will include on a fast entry basis very big ones. So rocket companies, for example, came in between rebalances, their quarterly rebalances, so we could include the really large ones. The interesting thing about our international product, which has not been out as long as the US, is China and the fact that the Chinese companies are going to pretty soon not be able to come public here unless they follow our US regulations on accounting disclosure. And so what's happening is we're getting Chinese companies rushing to come out here ahead of this window closing. Like Lufax, one of the very large peer-to-peer lenders, is going to come public here. But Alibaba's Ant Financial, which is going to be the largest IPO ever, is not going to come public here. It's going to come public in Hong Kong. And so our international IPO ETF, which includes stocks outside of the US, is going to be one of the early products that can hold Ant Financial. And well, it's not that well known here. It is going to be a very big name and an important name to hold in portfolios. So the international product will give exposure to that, and you can buy this in US dollars. So you have it's a vehicle that's efficient for a US dollar investor.
When will Ant Financial go in the international? Do we have a timetable for when it might go public yet?
We think in the next month. In the next month.
Next month. And when would it go into the International IPO ETF?
Well, given its size, it will go in before a rebalance. So as early as after 5 days of trading, we're going to include that in the ETF, the International ETF, because it's so
within
big.
5 days of it going public?
Yes.
Is that right? Within 5 days, you could put it in?
Yes. After day 5.
Oh, okay. That's a very important point. Thank you, Kathleen. That's very good information. I just want to move on. A final little point I want to get to. And I get this question all the time from investors in ETFs about the yield problem that we've got out there. A lot of bond ETFs are now throwing off yields of 1 to 2% range. I don't know if we can put this up, but here's some yields of some big ETFs that are out there. The big one, AGG, the aggregate bond, 1.2%. The LQD, investment grade corporates, only throwing off about 2%. The munis are throwing off 2%. High yield about 6%. So I guess the question is, what do you do about all of this? And Christian, I'm going to turn to you. You've got your Amplify High Income ETF, YYY, which I find very interesting. It tracks an index of U.S.-listed closed-end funds. Now, this has a much higher yield, but it's a slightly different product because you're dealing with closed-end funds. Very briefly, could you tell us what's in this and why you think this is an alternative for people looking for yield?
Sure. So closed-end funds are, kind of the lesser-known type of fund in the U.S. There's mutual funds, there's exchange-traded funds, and there's closed-end funds. Closed-end funds actually started, though, before all three of those categories. The odd thing about closed-end funds is that they often trade below their net asset value, meaning you can buy them at a discount to what the actual securities are valued. So YYY tracks an index of discounted closed-end funds. These closed-end funds are stock and bond closed-end funds managed by some of the biggest names in the industry, BlackRock, Lake Mason, and Nuveen, and they're all designed to produce high current income. So YYY's index seeks to own 30 that have a kind of the highest blend of discount to NAV as well as distribution rate. So currently YYY owns 30 closed-end funds that trade at a 13% discount to NAV. And what that does is produce high current income. The current SEC yield on YYY is 8.85%. How can we do that? Essentially, we're buying, a dollar's worth of assets for 87 cents. That's that closed-end fund discount that we're taking advantage of. And then those funds themselves are all income-oriented. So this is a more volatile income investment from an NAV standpoint. The trade-off is you should get quite a bit more high current income over time. So this, we think, is an alternative to some of the traditional bond ETFs. It's an ETF of closed-end funds trading at a discount. I think it's fairly unique and potentially, if you're thinking about an income investment, it's probably one side of an income barbell. You may have more low volatility, conservative income investments on one side. On the other side, a higher yielding, more volatile side of the barbell, which YYY would fit in. Okay,
John, this sounds like a great deal. 9%, who doesn't want 9% yield versus 5 or 6% for a high yield fund? But then again, you're in closed-end funds. Is there something we need to be mindful of here, John?
Yes, I think you need to be mindful that the discount to net asset value may never close. There's no guarantee that these things will reach their net asset value. They are expensive. And I think that investors should really look at total return as opposed to just pure yield. So I'm going back to what I mentioned before about IPOs. If you're going to take on the risk of owning a financial asset, you should be compensated for taking that risk, right? Same thing like, in life, right? If you're going to start a business, you should be compensated for starting a business. And I just don't think that happens with closed-end funds. I see a volatility, a standard deviation of about 17%, which is the same standard deviation as the S&P 500 ETF. And then if we talk about the total return over the last 3 years, the S&P 500, has produced a total return of 50%. Whereas YYY has a total return of about 2%. I think there's other ways to generate yield if people are just going to be purely focused on yield, and they've got, if they're running a pension fund and trying to match, liabilities and assets. But, LQD, I think, is attractive from a yield perspective. I think PFF is attractive from a yield perspective. Even HYD, the high yield muni ETF, I think is pretty attractive. All those have much lower standard deviations, higher total returns. So on a yield per unit risk basis, I think that you're better off in those areas compared to closed-end funds. I think the key is just to be mindful that these things may never reach their net asset value.
Okay. Again, all sorts of alternatives out there. This is a question, probably one of the top 3 questions. What do we do? How can I get better yield? So I thought we'd bring up some alternative investments. We've gone a little long, but we had a lot. We covered a lot today. You've gotten the best advice and opinions in the business, folks. I hope you all understand that. We bring it to you every week, and that's it for this week. Sorry for going a little long, but again, very important information. My thanks to Kathleen and Christian and John. Just a reminder, all of our shows on our website, etfedge.cnbc.com. Don't forget our podcast. We'll go into a little more in-depth about some of the topics today. Thanks, everybody. Have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.